Hello traders, Gary Wagner here, approximately 8:45 in Honolulu, making it 2:45 in New York on Friday, the 19th day of April 2013, and this is a special edition of the weekly review of the gold forecast. And what a week we have seen. One of the most brutal sell-offs witnessed in the history of the precious metals markets as we saw gold plunge between Friday and Monday plus $200 currently as we stand, well off of the highs. The highs actually being 1426.10 as being reported by Kitco Metals, low 1391.10, currently at about 1398, 1399, let's call it 1400, up about $7 on the day. Silver just almost holding its own, as you can see, 23.18, 23.16 in that area. Puts it off about a dime on the day, about a 0.5% lower. Low at 22.83, and the high is 23.96 on the day. Now, before we get to this week's review, I kind of wanted to get up to date on the trade recommendation we made last night, reasons behind it, strategy for where we're looking to exit the trade, what kind of risk reward we're looking at, and basically what are the charts telling us. First of all, it's quite obvious. We witnessed one of the strongest sell-offs, 7% drop this week alone. We hit a major low, 1320 was that low. We are looking at a 60-minute chart. Let me go ahead and compress this. And you can see this virtual drop out of the sky, this free fall. As you can see, the market plunging 1600 here at the top, 1320. And here's the key. Here's what we're looking at. As this market fell down, it did absolutely find some very, very strong support, 1320. It came back up, but it found very strong resistance at around 1400. Made a second attempt, 1400. This being the 16th and 17th. And then yet a third attempt. And you can see, as we were talking yesterday, we were looking at the fact that these candles on this short-term chart had really gone back into what we call a consolidation pattern. And simply put, consolidation pattern is where you get the candle color being of alternating color and the body size being rather small. And the key was this. I had recommended at that point, seeing as we were trading within a fairly defined range of 1320 to 1400, and that was up to here, my recommendation was we would look to sell above 1400 and buy 1340, 1350. I also said in my report that if it breaks above 1410, really all bets are off, because if it breaks above these highs right here, that's very significant, and it's significant for two reasons. First of all, that higher high is following a higher low. As you can see, the first low that we made, 1320, market comes back, stalls at 1400. When it comes down, 1340 was the next low. So we made a higher low and a higher high. Now, as you can see, the market retraced a little bit, but has gone back to green and is now trading once again over 1400 per ounce. Also, before we start to review the week at large and some of the more compressed charts, our daily, 3-day, and our weekly, taking a look at a 240-minute chart, standard candlestick format. And what we have charted was our fib retracement from the drop to 1320, and we have put in a couple of benchmarks. Now, these benchmarks should give us some insight or indication should the market continue to move up and ascend to higher pricing. Our first level of real resistance, of course, was 1400. We will then have a small level, 1441, 1473, and then 1506. These are the three levels of resistance that should the market continue to trade higher, we could in fact encounter some resistance. So strategy in terms of our exit and exit points, these are the particular strong benchmarks that we'll want to consider if in fact the market finds good support at 1400 and begins to move higher. And I think that there's a decent probability that it will. Now all I've done is converted the 240 to a 480, then converted it to a standard candlestick. And the reason for doing that is just to show you the top and bottom in terms of where I am fixing our fib retracement. As you can see, approximately 1320, 1318 on the low side. That's the bottom, 1620 on the high side. $300 move, and that drop was quick and brutal, as you can see. Also, when we look at these intraday, we are solid green on the Henkin candles, and then, as I said, most importantly, it was the break above these highs at 1410 that really caused me to signal the trigger, along with the other variables that I look at, candlestick patterns that we were able to identify, as well as a good pivot or reversal point when we looked at the Japanese average charts. Now that we've got the trade strategy and parameters underway, let's tackle the 800-pound gorilla in the room. And that gorilla, of course, is the bull market over? Well, there's no doubt we have seen a major correction transpire, not only from these record highs at 1920 as it oscillated between 1800 and of course 1500, but this last breakdown was absolutely immense. Now, let's consider this. Even in a bull market, it is characterized, according to Elliott wave theory, by a period of impulse phase, meaning rapid succession of higher highs and higher lows as it zigzags through typically a series of 5 waves, 1, 2, 3, 4, and 5. First part of Elliott wave theory. Second component, in a bull market, that 5 impulse wave count will be followed by some sort of a corrective phase, typically an ABC, or something along the lines of what we've witnessed recently. We're looking at it as a double ABC. And of course, you will have your correction, A, B, and C, just for illustration purpose. Now, assuming that the fundamentals that were in play during this 8 wave cycle, if those fundamentals are still in play, then this pattern repeats itself. So we would then go back into 1, 2, 3, 4, and 5. The question you need to ask yourself: have the fundamentals changed? Now, obviously, there have been some really key changes that have transpired. First off, the incredibly loose monetary policy, not only of the United States, but the European Central Banks, Bank of Japan, at some point will end. That's been really fueling this gold move unlike any other fundamental out there. That's my belief. We have very little inflation going on right now. And according to many, the idea that gold is a safe haven asset is even moving out of favor. So the only thing that really has to remain consistent, in my opinion, is the fact that gold is a benchmark when weighed against other currencies, and as long as those currencies are being debased, are being watered down, are having false liquidity added to that base, at some point the bill has to be paid. That being said, there can be a logical contention for the fact, and here we've got ABC, 1, 2, 3, 4, 5, ABC, 1, 2, 3, 4, 5, ABC, 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5. My belief is that the way this has been reacting, I'm of the belief that this has been a major fifth that we experienced. We weren't in the major third, but in our major fifth. And that's kind of been a long-standing argument between me and another Elliott wave technician. And we've been debating this back and forth for about a year to a year and a half. In either case, the most important part is we're certainly in our corrective period, and we certainly have had now a standard C wave, meaning the C has gone below these A's. That being said, and when you look at the support level, $1,300 holds, and that's a 50% retracement, of course, from about 700 to 1900. As you can see right here, that's what this retracement represents. And so, what I believe is that 1, 2, 3, 4, 5, large A, B, and C. If in fact the parameters and the fundamentals that have been in play, if you believe they have drastically changed, things have absolutely turned even 90 degrees, 45 degrees, then we could enter a bear market, because this is still a bearish correction within a bull market, and that of course would be reversed. You get 1, 2, 3, 4, 5 down and ABCs are up. My point is that the writing on the wall isn't necessarily dry yet. And this could easily be, although a substantial, tremendously devastating correction, this could in fact be just that, a correction within a bullish market. Is the bull market over? Well, the jury's not in, and I think that it's quite possible that we will conclude this corrective period and go into an impulse period. If that in fact happens, we will need to break through various levels, including 1800 and 1700 per ounce. You know, for those of you who have been with me for a while, and even those who have joined recently, you realize that I've been labeled as a hybrid technician. I absolutely believe that fundamentals move a market. It is not technical indicators that really create the inertia that precipitates any kind of rally or sell-off in the market. However, it's also my belief, and it's the reason that I'm such a staunch technician, in that it is very easy to listen to all the pundits out there, all the analysts out there, and end up being thoroughly confused because both sides of the fence are making assumptions and arguments that have plausible scenarios. Math is a pristine science, and it cannot be black, it cannot be gray, it can only be black or white. Looking at a 3-day chart, standard candlestick format, and as I said, we certainly broke down something tremendous, and now I'm reading articles, or seeing articles I should say, that say gold's going to 1100 or to 800. I don't really pay that much credence to those, but I will tell you, when we heard the downgrade from Goldman Sachs, it was interesting to see how quickly the market melted following that statement, that updated call in the market. Now, in terms of the way we have to look at it, I showed you a longer retracement, which we saw the market fall about 50%. Now, this is a much shorter retracement, obviously, and it is simply going from 1139 to 1920. And then as you can see, our 61% retracement takes us to 1438. But the deepest of all retracements, 76, takes us to 1323. And because we get that kind of a harmonics, meaning the two different sequences using two different highs and lows, coming up with a similar area, 50%, 76%, right in this area, to me lends credence to the validity of that price point having some really strong support. So when we look at the chart, even through our 3-day standard candlestick, you can make a case for 1323 being able to hold. We'll have to see, but the way it jumped off of those lows, making a higher low this week, certainly felt like a bottom forming. My last observation that I do want to make for gold on today's special weekend review, and it's also in silver. When we look at a silver chart, you'll see the same thing, and that is that as this market fell, it formed a price void or a gap. Now, it's not a true gap because you have these wicks going into that area, meaning the lows and the highs are laying over each other, but you do have a gap in terms of the real body. You can see that right here, right at 1480. For that reason, my sense is that what we're going to witness is this market moving higher and filling this gap. Now, in terms of silver, I have to tell you, I am definitely not as bullish as I am in gold right now. One of the reasons is it has been dramatically selling off to a greater percentage because I believe of the industrial component within silver itself. When we look at this particular chart, it is a daily chart, standard candlestick format. Let me go ahead and blow that up. But the first thing that I do want to point out is a similar price void. And this, again, this is daily silver. And you can see this gap or price void right at around, call it, about $26 per ounce. And my sense is that similar to gold, if in fact we see silver move up off of these lows here, I believe that it will go and fill this particular price void. Now, take a look at the daily chart, or think about the daily chart that we just took a look at in gold. And I guess the best way to look at it would be really to look at it side by side. Daily gold on our left, on our right, we've got our silver. And as you can see, look at the pristine formation that has formed over these last trading days. Standard candlestick format, they are small-bodied candles, but we've had price ascent as it came off these lows of 1320 and has took a stab intraday today at 1420, 1424. In the same way, when we look at silver, we had the first day being equivalent to gold, but look at these last three trading days. They have closed virtually where they've opened, small-bodied, consolidated, and really no price ascent whatsoever. Completely different ways of reacting to this most recent sell-off, and that is why I do have some concern with silver, especially when you compare it to gold. This has been Gary Wagner, wishing you as always good trading. We had one interesting week this week. Talk to you on Monday for another daily update review. Bye-bye.